Perfect. We are live now, Vivek.
Okay.
Welcome, everybody. Thank you so much for joining us yet again on our webinar for the month of January. This is the first one for the year, and we're very happy to have all of you here with us. Vivek, I'd request you to quickly share your screen so that we could share the results and answer all the questions from everyone.
Yeah.
I will just give me a moment. I'm checking that we are live. I can see an error. Just Vivek, just give me one moment.
Sure.
Okay, I think we are live. All right, Vivek. Let's begin with the presentation. If you could please move on to the first slide. Okay, so as always, we'll talk a little bit about Estee and Gulaq for all the new people who've joined us in the last month. We'll share the rebalance for this month and the breakdown of returns, as a lot of you have asked us about the same. And we'll delve into the questions and answers that you've asked us in the form, as well as take more from the chat section. Okay. Now, moving to Estee, as you know, Estee is a pioneer of systematic investing in India. It was launched in 2008 when SEBI had permitted algorithmic trading. And since then, we've created a lot of products using analytics and computer science, broking as well as investing products. We have our own portfolio management service, which is PMS, catered to HNIs. And somewhere in 2020, we thought that, hey, why not offer this to the retail clients like you and me as well? So we launched Gulaq. So far, we have already served around 30,000 clients in Gulaq. Vivek, if we can move to the next screen, please. Yeah, thank you so much. So this number is 30,000 now. We've served more than 30,000 clients so far. And we follow a multi-factor algo-based investment strategy in our Gear 6 flagship portfolio. But a lot of you who've been associated with us since a month would know that in last year in December, which is just a month back, we launched 3 new portfolios, brand new portfolios, which are market cap based for all our investors. So we'll talk a little bit about those also today. Yeah, Vivek, next slide, please. Okay, the 3 people in the team that you keep seeing on TV, on on YouTube and on our Instagram pages. But of course, there is a whole big team behind us who are helping us out. Just to talk about Sandeep and Vivek. So Sandeep is the founder and CEO of Estee, and he has 30 plus years of experience in this space. Vivek is the investments head and the marketing head, and he has 20 plus years of experience. And myself, I'm Eesha. I'm a business manager, and I also have 6 years of experience in consulting and financial services. Are you there? Yeah, Vivek, are you there? Can you please move to the next slide?
Yeah, I've moved to disclaimers now. Can you see
Okay.
disclaimers?
Yeah, now I can see it. So just some disclaimers which we always present at the beginning of the presentation, because as a SEBI registered investment advisor, it is our duty to inform all our clients that, hey, investments in securities markets are always subject to market risks. So, you should be aware of all the associated risks, and you should, of course, read all documents carefully. You should question us if you're not sure of anything, and you should look at all the disclaimers of the advisor or the person you're consulting for financial advice. So you could always rewind back to the screen and read the disclaimers, because it's a recorded session on YouTube. Yeah. Okay. So new market cap portfolios, So we've divided it into 3 categories on the basis of market capitalization. Large cap is basically defined as the top 100 companies. Mid cap will be the 101st till 250 companies by market cap. And then 251st to 500th company is the small cap portfolio. That's the universe that we are looking at when we create our portfolios. Now, as you see that we focus on 15 to 20 stocks in each category. We pick those up and we again create sector agnostic diversified portfolios for you. We still believe in our strategy of focusing on all sectors and not, making the end client figure out which sector would work well in a particular economic regime, because not all of you will be well averse with the market movements and the different themes and industries. And lastly, we also monthly rebalance this portfolio like our other portfolios so far. Now, talking about the back-tested as well as the live returns, you would see that the large cap in the last 1 month has actually, of course, the actual performance is minus 0.8%, but the Nifty 100 stocks fell by minus 2.8%. So the alpha, which is the excess returns, comes out to a positive 2%. So had you invested in an index fund, you could have lost minus 2.8, like you could have lost 2.8%, whereas in case of Gulaq large cap, you would have lost only 0.8%. So this just shows the return trajectory. And you can see the rest of the returns in the back-tested tables. Okay, moving on. Now the mid-cap as well. Mid-cap performed phenomenally well. As you can see, despite the mid-cap index being almost flat, it gave you a 3.4% return overall. And as like large cap, mid cap, as well as small cap, all three have 1 lakh minimum investment amount. Okay, moving on. Small cap, of course, it didn't do as well. The alpha is slightly negative. But then again, for both our positive as well as negative returns, 1 month is not a good time to, judge any portfolio or any investment product for that matter. So spend some time with an investment product that you've invested in, and only then make a conclusion on whether it's going well or not. All right, now coming to the 4 portfolios, which we always have had since the very beginning. These are the gear-based portfolios. I think most of you are already familiar with this. We have categorized it into 4 different categories based on the risk levels or the risk appetite of investors. So for an aggressive investor who can drive at a high speed, they can drive at gear 6. You have the 100% equity portfolio and so on and so forth. The debt component keep increasing as the risk profile keeps going more towards conservative investors. All right, Vivek, next slide, please. So these are just the market cap weights in our gear 6, in all our gear-based portfolios. You will see how we have shifted from December to January. We have shifted more towards mid cap as compared to large cap, and that is also visible. The mid cap portfolios did perform quite well. So in our gear-based portfolios, please do not confuse this. We are not talking about the market cap-based portfolios here. These are our gear-based portfolios, which are also market cap agnostic. So they have allocation towards all 3 market caps. And over here, we are just comparing that over time in the last few months, how our market cap allocation has changed for our gear-based portfolio. So this is what it shows you. It has moved more towards mid cap from large and small cap. Yeah. Again, something that we show you every time for the last 3 months, we show you how our sectoral allocation has changed. So you can see the weights and compare them from December to January. You would see that consumer staples has been our choice since the last 3 months. And we have in fact allocated a little more towards it. Same is the case for consumer discretionary and materials, whereas we have pulled out a little bit of money from industrials and completely from real estate and healthcare. And as we discussed, this is all algo-based. So there is no manual intervention. There's no human who's deciding which sector to allocate more funds towards, because it's a fully algo-based strategy. It's a quant model. Now, similarly, momentum. So we went into momentum in November and December, but we are again out and we are focusing more on quality stocks this month. The returns for all the people who were asking questions that, it's performing negatively. We got some questions in the form also. But as you see, the last month, we did a little bit better than the benchmark. So like we always keep saying, stay invested for a little bit of a longer duration to judge any product. Markets are volatile. So just like the markets keep moving up and down, the portfolio also could move up and down. So give it time. And these are the returns. You can always rewind and have a look at these. That was gear 6. This is gear 5. Then we have Gear 4 and Gear 3 as well on the next few pages. Gear 4 was launched a little later. That's why the returns are only till 2 years. Yeah, and that is Gear 3. We will again see a similar trajectory in the last 6 and 3 months. It was not as good. Similar was the case with the markets, but this month it was still better compared to markets. And this is just a comparison across all our portfolios. Again, it is very obvious that Gear 6, because it's a 100% equity portfolio, it will have the highest returns, both upside as well as downside. But as we move more towards debt in Gear 5, 4, and 3, it becomes a more slightly comparatively safer product. So the volatility of returns, of course, reduces. Again, a chart that we have been following since quite some time. On the left, you can see how 100 rupees invested in Nifty Multicap and Gulaq Gear 6 would have grown in the last 4.5 years from May 2020 till today. You will see that Gulaq would have given you a CAGR of 50.2%. And CAGR means compounded annual growth rate, which is year after year, you have earned 50% return. Of course, it's not possible that every year you will get 50. So this is like an average. This just says that 100 till 670 today. What will be the average rate of return every year so that in a compounding fashion, you will make this much money. Similarly, for Nifty Multicap, it has grown from 100 to 296. So that's a 27.5% CAGR, which is compounded annual growth rate. Now, on the right side, you will see the comparison between Gear 6 and Nifty Multicap on an annual basis. So calendar year 2020 till calendar year 2024, the orange bar is Nifty, which is a benchmark, and Gear 6 is in blue. That it has outperformed consistently. This year, in the year of 2024, it did outperform by a very slight margin, but overall, this has been the trend. Okay, we have also shown the key winners and the losers of 2024. So this is what has already happened. We are not showcasing the current portfolio, but how the performance had been in the previous year. And of course, no past performance is guaranteeing any future returns. So please do not feel that whatever happened in the past will definitely continue. This is just an indication of the past. So you will see that, all the top performers, what their weights were and what were the total returns that they gave while being in our portfolio. The highest has been quite high. So you will see that the winners have given us a lot more return than the losers have lost money for us. So this also is an indicator of how well a strategy is performing. It tells you that the worst picks by the manager. So on the right side, the key losers means what were the worst picks by us and how much money they lost for us. But their weightages were also low. Similarly, when you look at the winners, it tells you what were the stocks that gave us the highest returns while they were part of our portfolio and what were the weightages of the same. I hope this gives you some insight. And now we are again comparing the sector-wise performance. So you will see the average weights and the total returns across sectors in Gear 6 and in the benchmark, which is BSE 500 over here. Okay. Moving on. Again, so this is a comprehensive analysis of how our last year has been compared to the benchmark. Typically, we don't show these numbers, but since the year has ended, we want to present to you an annual snapshot of how the performance has been across different sectors. So the average, how much average weight has been allocated to the different market cap categories by us and by BSE 500, and what has been the total return. And at the bottom, you will see that as per Bloomberg, how large, mid, and small cap has been categorized, because the benchmark will have that categorization when they evaluate the stocks. Okay, now we move on to Ask Me Anything. So that's the Q&A round. We got a lot of questions in the form. So Vivek will be taking those first. And I'm sure the chat section will have questions right now. So we'll cover those as well. So please stay with us. Yeah,
So,
Vivek.
Eesha, let's take the questions that we got, live questions first, and then we'll take these questions.
Sure, we can do that.
Yeah.
Just give me a moment.
We can do that. Yeah. Just give me a
Okay. Oh, I don't see a lot many questions, Vivek. So what I see is Anirudh is asking that following the Gear 6, he's been following Gear 6 since the last 3 years, and he recently
Okay.
noticed significant shifts in the number of stocks from 7 to 8 to 32 and now back to 15. So could you
Okay.
explain the rationale behind these drastic changes? I think we covered it in the last webinar, but we can do that
Yeah,
again.
so we have made some changes over the past couple of months. So earlier model used to have somewhere around 10 to 12 stocks on average. On the high, it could be about 13, 14 also. On the lower side, it could be about 8. So pretty much the range was that, about 8 to 14. After that, what we have done is we have added a sector uh, ranking block. uh, and when we moved to that specific model, we moved our overall portfolio. The best results were actually coming in the 35 stock portfolio for a month. But then over that month, in the new sector rotation block, also we have improved our overall methodology. And secondly, there was some feedback from the existing investors also that 30 to 35 is a bit too high. Because of these reasons, actually, we moved back to 15 stocks, but with the newer methodology only. So if you watch our overall last couple of webinars, in that we have clearly explained uh, how newer methodology is actually better than the older methodology, both in terms of the churn. So the churn reduces from earlier, I think it was used to be about 80 to 90%. Now it should be about 50% or so. And in terms of expected returns, at least as per the back tests, this slight improvement in the returns, and the risk remains roughly same or slightly lower. So overall, this portfolio becomes a better version, and this is the first time that we have changed since we launched our portfolio way back in 2020. So now we are going to stick with this specific portfolio where you are going to see more or less about 15 stocks in this portfolio. Yeah.
Okay. Okay, so Rohit says that how come stocks in Gear 6 keep disappearing and appearing at regular intervals? For example, Colgate has come into portfolio now, but was dropped a few months back.
Yeah. So, Rohit, I think this would be a factor in any quant strategy. These quant strategies, what we are able to do as compared to the discretionary fund managers, where they have a team of analysts and they study companies in and out. So what happens is when an analyst is studying companies, it usually takes far longer for them to analyze a specific company and to decide whether to make it a part of their portfolio or not. So that research process can take a few months or even few quarters, right? Now here, I'm not saying that is something wrong. I'm just highlighting the difference between our approach, any quant strategy approach versus a discretionary approach. Now, discretionary approach, just because it takes much longer for them to analyze, they also tend to hold on to these stocks for much longer, typically few quarters, right? Quant strategies, by their very nature, we analyze high frequency data, which means on a monthly basis, there are a lot of changes that are occurring in these specific stocks, or even in the overall macroeconomic environment. Now we take all of that data, which is let's say prices of essential commodities, how the inflation is changing, or how the prices of these individual stocks and sectors, how that is changing, right? So we are able, because we use computers and algorithms, we are able to analyze that tons of data much faster, and that is why we are making these decisions to buy and sell at a much more faster pace, right? Now there is a thing known as sensitivity. Now we can take historical data, let's say last 12 months data or 24 months data, and when we use that, the the changes in the portfolio will be far lesser. Whereas if we take shorter term data, the changes would be higher. But there are pros and cons on each side, right? If we take longer historical data, what would happen is we will be changing our portfolio at a slower pace. So we'll be slow to react to the really good changes. Let's say if we have to get out of a stock, there is a stop loss. So, and if you're using historical data of about 12 months or so, we'll be very slow to exit from that stock, right? But we'll be slow to enter also if it is a right stock. So there is a fine tuning going on between what historical data we should be using, right? But by very nature, most of these quant strategies will have higher churn, and because of that churn, we are able to produce better risk adjusted returns. Just because our stop losses are defined. So let's say a stock is in momentum, right? Um, let's say Adani stocks or any other stock that is very much in momentum. Every month it is giving 5, 10, 15% kind of returns. And if we end up selecting that, uh, we'll be very fast to get out also. That's the positive side of higher churn, that we are very fast to get out also. Now, obviously, there'll be few stocks in which these decisions would turn out to be wrong. And after a few months, again, when it starts rising, we will end up entering that. So by very nature, these quant strategies actually would always have much higher churn as compared to other strategies.
Makes sense. And I think, Vivek, this is also related to other questions. So
Hmm.
Rohit says how, no, this one's done. Um, so basically, Shubham says, what's your current strategy and which sector will be on focus? And Kishan asks कि sir in Gulaq small case में finance को weightage नहीं है ऐसा क्यों?
Okay, so let me quickly share. I think this is something that we just shared some time back. Uh, our current portfolio. Yeah, you can see my screen.
Yeah, Vivek.
Okay, so if you look at, no, sorry, this is not the data. Yeah, this is the data. So if you look at the sector-wise weightage of January, you can see consumer staples is the sector that we are most bullish on. We have 44% weightage to consumer staples, whereas in BSE 500, this has just 7% allocation, right? Rest, it's pretty much in line. Energy, consumer discretionary, and materials is pretty much in line. And the major thing is financial and information technology. We have about 5% weightage. So we are underweight these two major sectors, financials and IT. We are underweight this. Now, this is a result actually of, it's very hard to explain in terms of reasoning, because this is all a result of the multi-factor methodology that we are using, that Eesha just spoke about some time back, that we use maybe 100 plus factors at any point of time, and out of that we pick what are the factors that are most likely to work in the current market regime, and using that factors we pick these stocks. At the end of the day, what stocks end up getting selected, it's based on huge amounts of data only, and we have no say as human managers. We don't have any say, depending on, we might be biased that IT sector is getting very good valuations right now, I might end up selecting IT. So we might be biased, and that is something that we avoid, because we as fund managers have our expertise in designing these algorithms. We don't have really very good expertise in uh, discretionally analyzing stocks or sectors and then picking, right? Our capability, our skill set is in using data to pick these stocks and construct these portfolios, and and that's how this gets done. So it's very hard for me to pinpoint specifically what exactly is the reason why a specific stock is getting extra weight, or why it is getting out of the portfolio. So this is a part of the overall methodology that we use, and we have spoken about these methodologies time and again, how this has even in live markets and also in the back test that we have seen, it's really a very powerful strategy that we have designed.
Right. And just to add to that and clarify, in for a fund manager who's actually looking at data uh, by himself, who's looking at news, who's looking at annual reports and balance sheets by himself or herself, they may have some personal view their own view of how the market will go, how which sector would perform better, which won't. But in our case, since it's a quant model, it's an algo-based model, our fund managers have expertise in studying market data, which is in lakhs and millions of data points. So, through Bloomberg, through Morningstar, through a lot of different tools and subscription services, we get this data, we evaluate it, put it in a code, and create codes also, which can churn the best possible portfolios. So a lot of numbers and a lot of data is actually analyzed by our fund manager and the team to look at how the markets will go. And based on the output given by the computer, we say that, okay, this we will move or we will shift allocation from one sector to the other. So they don't have any personal view and they are not tracking the news to form a view, because we feel that a person may read the news or read the annual report differently from another person. So there could be bias if there is a manual reading of the data. So we rely on computers, and that's why it's a quant or an algo-based strategy that we follow. Okay. Now, a lot of other questions, Vivek. You want to continue with the questions in the chat?
And we'll continue these questions first, and then we'll take up the others also.
Sure. All right. So Sony says my Gear 6 portfolio is around 15 lakhs. If I split it between Gear 6, Gear Gulaq Mid Cap, Gulaq Small Cap, what is the best way to allocate 15 lakhs between the three? Thank you.
So Sony, this is something, see, we launched these market cap based portfolios early last month. And the whole idea was that there were few investors who were experienced investors and who wanted more flexibility, more control in allocating capital to these market cap based stocks. And that was the whole idea of launching these market cap based portfolios, that we wanted to give those experienced investors who want to take a specific call on a specific market cap category of stocks. So what I have to say is, uh, if you have the capability, if you have the interest and experience in evaluating these specific market cap based categories, and then you have a specific call that you want to take, that is when you want to enter into these specific portfolios. Otherwise, if you really don't have that kind of experience, then the better thing to do is to stick with these gear based portfolios, because that encapsulates all these different market cap categories, right? So that's what I have to say. It totally depends on your experience and your skill set. If you have that kind of experience and skill set to evaluate, then only please go ahead with these market cap based portfolios. Don't look at the historical returns and then decide, because it will involve some bit of uh, market timing from your side, which only very experienced investors should be doing.
Right. And a related question from Anirudh. He says, is there a plan to introduce theme-based small cases under Gulaq? And secondly, could you consider offering a subscription model where subscribing to Gulaq provides access to all Gulaq small cases?
So second point first, this is something that we have discussed with the small case team also, because it's dependent on the small case platform. We'll be definitely happy to provide this kind of subscription based services, but this is a limitation as of now with small case platform. We have definitely discussed with them. Let's see if they have any plans to roll it out soon. We'll check with them. But this is something that we have discussed earlier, and it's a limitation of the platform currently that we are using. And secondly, your question regarding, do we have any plans to launch? So I think that depends on the overall interest from the investors side. We do definitely have the capability to launch these kind of portfolios, and one of the portfolio that we are also considering is longer term portfolio in which rebalancing gets done once every year. So that was also one of the demands from the investors side. So we keep looking at where all the interest is, what investors want, and that is something that we can consider in the near future. But as of now, nothing we are not looking at anything actively. But yeah, depending on the interest, we can definitely launch these kind of thematic portfolios. But those would be specific factor-based themes only. Yeah.
Right. So another account called Marina for You is asking how much maximum investment we can do in Gulaq Gear 6 for good results, and so that it doesn't affect the stock churning effect on it.
So I think one of the things that you got to see is you're not too concentrated in any one portfolio. So what we have typically advised is that, let's say if you have 10 lakh or whatever is the corpus, you divide it into maybe between 4 to 6 mutual funds. It could be mutual funds or these small case portfolios. So maybe between 15 to 20% in any one fund maximum you should keep. On the higher side, maybe it could go up to 25%, but that's the broader range that you should keep. So depending on your overall portfolio, then you have some idea about the 1/5 of the portfolio you can keep in any one fund. And Gulaq Gear 6, again, it could be one of those funds, right? That was the first. And what was the second part, Eesha?
Vivek, the second part says that, the churn, how can we like maximum investment, which
Yeah,
doesn't.
maximum. So that is one criteria. Second is, I think what I have seen when your portfolio goes beyond 25, 30 lakhs, I see that impacts the overall slippages a lot. That's what I have seen even in my portfolio. So then we start uh, recommending to have a look at our PMS, because in our PMS, obviously the minimum ticket size there is 50 lakhs, but there we are able to control this execution very well, and we are able to control those slippages that you get. So there's a lot of benefit in looking at that PMS. If you have reached, let's say, 30 lakh plus, kind of 25 to 30 lakh plus, then one thing that you can consider is RPMs.
Got
Yeah.
it. The same person is asking that, any plan of Gulaq to give access of other small cases which are newly built up for existing customers. And, if we should offer any discount at the time of renewal.
Sorry, I did not get newly built.
So they are basically asking that should any plans of us offering any discounts to our
On the
existing
newer portfolios.
portfolios that we have created.
Yeah, I think we already have some discount coupons, and uh, we have sent out emailers to all our interested investors and also our existing investors information about this specific discount coupons. So I will encourage all of you to please check your emails. Most likely you would have received an email from our side. But if you haven't, Eesha, can we share the discount coupon right now? I don't remember off the top of my head what exactly it was,
Yeah, even I don't have it right now, Vivek. Maybe.
but we can, maybe you can quickly ask what's the discount coupon, and we can share it here as well.
Sure.
Yeah,
This is for existing investors or for everybody?
for everybody, because there might be others also in this call,
Mhm.
so we can check, right?
Sure, I'll just check while we cover the rest of the questions, and in the end, we can share it with everyone. So please stay tuned. Now, another question from Stock Market Dost, that's the account handle.
Yeah.
This, what is the cost adjusted returns in the new strategy since 2012?
Okay, so see, the returns that we shared, those are again the back tested returns. So they are not very good predictor of the future returns. But in those specific returns, we have taken into account slippages and brokerage costs. That's what we have already taken that into account. So the results that we have shared are cost adjusted.
Okay. All right. So that's the answer. You can always rewind and see the backtested results that we had shown at the beginning of the presentation, and you'll know what they were. Now, coming to the question from Manish, he says the weightage of 15 stocks are the weightages of each of these 15 stocks are very different. Could it be because of SIP strategy that I have taken, or is it deliberate?
You mean the weightages that we recommend in our
Yeah,
portfolios?
I think he's getting very different weightages he can see. So he's asking if it is because he's using SIP, that's why he's getting different weightages, or is it something that was deliberately done by us?
Okay, see, I'm not sure whether I understand the question because
Hmm.
when somebody does SIP, so let's say if I have existing portfolio of say 3 lakhs, and if I'm doing 10,000 rupees worth of SIP, now that 3 lakh will be exactly as per what we have recommended, right? The weights. But that 10,000, when you invest that 10,000, because the minimum requirement is about 25,000 rupees, what happens is that 10,000 for that part of the month would not be exactly as per what we recommend because it's a smaller amount. But it will only be for that part of the month. So if you have done your SIP from, let's say, on 10th, so from 10th to 30th, on that 10,000 rupees, your weightages would be slightly deviated from the model portfolio. But when you again rebalance your portfolio on the 30th or 1st of next month, then again, it will be, your portfolio will be exactly as per what we have recommended in the model portfolio. I think that is what he was asking.
Yeah, I think that's what he was asking. Now we can't tell him clearly as to, because we don't know what weightages he saw and how they are different from our recommended strategy. So Manish, one thing that you can do is you can go to your Gulaq, the overview page of Gulaq. Uh, let's say you've invested in Gear 6. So you can go to the overview page of Gear 6. Over there, you will be able to see all the stocks along with their weightages. And when you are trying to invest additional amount through by way of SIP, you will see the weightages that are being actually implemented for you at that time. So you can compare and you will get to know that if there is a difference or not. If there is a difference, yes, most likely it is because you're choosing an SIP and your amount of SIP may be smaller than the 24K minimum investment amount. But if you still have questions, if you see it's deviating by quite a bit, you could always write to us and we'll help you out. But shouldn't be a problem because even I do SIPs in Gulaq Gear 6, and I do see that, sometimes some stocks are completely eliminated also for each month. But like Vivek said, the next month when you do the rebalance, that amount of the previous month also gets rebalanced into the fresh portfolio with overall weights correctly mapped to the actual portfolio that we have recommended. So should be fine. Okay. Um, Amit says when the market goes up, we gain, but when market goes down, we lose. This is where we require a fund manager. But in spite of having a fund manager, Gulaq Gear 6 is not performing.
Yeah, so this question is from Amit, right?
Yes, Amit Midhavi.
So, Amit, I don't think that observation is correct. It might be the case in the recent past, but from what we have seen historically over the last 4 5 years that we have been running this strategy live, along with in the PMS also, and even the backtested results of 12 plus years, we haven't really seen any such trend that you are saying that whenever the markets are doing good, we do good, but if markets are not, we're not. So, I don't think that is something which is really a pattern which is repeated over long term. It could be that last few months this has happened. That is one thing. And secondly, obviously, I think we shared our returns. So this is one sec. Let me quickly share. So this is a part and parcel, the kind of performance that we have seen over the last 1 year or so. This is a part and parcel of investing in any active fund. So active fund by their very nature, we are trying to outperform the market, but at times what happens is uh, we underperform also. So we launched in 2020, and if you see last 5 year returns, 4 years were pretty solid, where we delivered alpha of maybe more than 20%. This year was a very average or bad year for us, where we couldn't really deliver. And this would happen with any active fund, no matter how good it is, that even the mutual funds or other small cases, that you would see that they're not really designed to perform every quarter or every year also, right? There would be definitely times where active funds underperform. And the only way to invest in these active funds is have a look at them over slightly longer term, maybe 2 to 3 years. Is 3 years is, I think, a fairly good time to look at their returns. And this is what we've shared earlier also. This is, I think, in line with our back tests also. So
Right.
if you see our back test over any 1 year period, there is, I think, 10, I don't remember exactly, but there's about maybe 10 to 15% chance over any given year or any given 12-month period that we underperform the index. So this is, I think, pretty normal. This is expected and expected as per the back test also. But if you see anyone who has been investing with us for last 3 years plus or even 2 years plus, we have generated pretty good alpha over the benchmarks. And I
Right.
can totally understand the frustration
Mhm.
that anyone who has been associated with us for last 6 to 9 months hasn't really tasted that kind of returns. Uh, so it's totally understandable, but I would want you to have a bit more patience with these, with any active strategy for that matter.
And even the returns of Vivek the last month, I think those have been pretty good. Like markets have fallen by even 2, 3, 4% in different categories, and we haven't fallen as much. So while we also went down, we didn't go down as much as the market did. So that way our alpha was positive. So, and that this is the last month. So again, we won't ask you to just focus on the last 1 month because we performed well during that time. We would ask you to look at the long-term picture, which is more than a year, in fact, 2, 3, 4 years, and then judge the strategy. Okay, now there is another. Okay, Amit says, sir, I've been invested for 1.5 years.
Yeah.
He's the same person who asked this question. So Amit, you should look at the returns of Gulaq year 6 over the last 1.5 years and see that you have actually made those or not, because in the last 7, 8, 9 months we have underperformed, but across 1.5 years it will be a positive trajectory. So if there is any reason that you are not making as much, you need to check if one, you rebalanced on time every month. Two, if you, let's say, are doing an SIP, because the returns that we are quoting, let's say hypothetically we are quoting 10% returns over that 1.5 years. I have not looked at the actual data. I don't know how actually they are, but let's say they are 10% over a period. And during that period, if you invest at the beginning of that period, yes, you will get close to 10%. But if you are doing an SIP and you keep investing every month, you may enter into the portfolio when it was actually falling. So your actual return at the end of the period, which is the XIRR, which is the time weighted rate of return, would differ. On small case, if you have invested for more than a year, you will see the XIRR. So you will be able to see that actually what is your return, what is your total return also. But keep in mind that in case it's an SIP, it could differ. And lost close to
See,
12 to
brokerages is one
15%.
thing because,
Yeah,
sorry,
brokerage. So,
because there's a lot of churn in these quant strategies. I
hmm,
would want everyone to look at their brokerages, what they are paying.
yeah,
And if it is too high, maybe look at other discount brokerages that you can move to.
that's true. That's true.
That can eat up a lot of the alpha that we generate.
Yeah. And there's another point he's mentioning, which is interesting. He says that he lost close to 12 to 15% of the profit generated. Same is the case with me, Amit. So I have been with this portfolio since the last 3 years. I had invested 3 years back. I had also reached to around 51%. But right now, my return has fallen to around 35 or 36%. So from 51, I've come down to 35, 36, which is because in the last 7, 8, 9 months, the portfolio, in fact, the markets also were going down, and so was the portfolio. So I also saw greater heights. I came down, but I'm still in the positive because I stayed with the portfolio for a longer run. Okay, now moving on. So interestingly, two people have asked if we have plans to move into SIFs, the specialized investment funds of SEBI that they've recently introduced.
Okay, from what I know, I think these SIF can only be launched by mutual fund AMCs. And as of now, we don't have that AMC license, but we are actively considering whether we should uh, apply for a mutual fund AMC license. That is something that we are actively discussing internally. But as of now, we cannot, by regulations, we cannot launch these SIFs.
Right. So Supriyo is asking what's an SIF. So Vivek, if you could help with that.
The full form is Specialized Investment
Yes.
Fund, if I
Yeah.
am
Yeah.
not
Yeah.
wrong. And that is a newer class of asset which has been recently introduced by SEBI. So earlier it was only mutual funds, or on the other side you had these PMS or AIF. So PMS, the minimum investment size was 50 lakhs, and AIFs it was 1 crore, which was meant for sophisticated investors, and it could offer a few personalized or very specific kind of strategies. Now, there were a lot of algo trading platforms also which were not regulated, uh, and which were offering these specialized strategies. And primarily, the reason to launch SIF is to bring these kind of strategies under the regulatory purview of SEBI. And that's why these specialized investment funds would be launched in the near future by mutual funds, where the minimum investment size would be 10 lakhs, and they'll have much more freedom to try out multiple kind of strategies. It could involve real estate, or it could involve FNO strategies as well. So there are a lot of clarities which we are still to get, but it could offer very unique specialized kind of strategies, but the minimum ticket size in this would be uh, 10 lakhs. So that's what the SIF is.
Right. And Marina for you is asking if we have plans to enter into mutual funds as well.
Yeah, that's what I told. We are definitely very actively considering this. It is a very big overall plan. It requires quite meaningful investments. So we are discussing that, and it will take a lot of time also just to get that license from SEBI and actually launch a mutual fund. It could be 1 to 2 year kind of project, right? So, but that is currently being discussed internally within
Right.
ST.
So Supriyo says swing trading also possible in this?
In SIF?
Yeah.
Yeah, I think those kind of strategies would be possible, which you really can't do in mutual fund structure, but those kind of unique strategies would be possible in SIF.
Mhm. So interestingly, Supriyo says that he needs something like PMS but don't want the execution slippages. So maybe Vivek, you could talk about our PMS and how the execution slippages are taken care of.
See, we are a high frequency trading firm as well. We have that kind of infrastructure. We understand the market microstructure, and that is why we are able to execute uh, the clients who are with us in PMS. That's the regulatory freedom that we have got, that we can execute orders on their behalf, right? And we use our own high frequency infrastructure that we have developed over the years to execute or rebalance these strategies on a monthly basis in a very, very efficient manner. Now, this kind of freedom, this kind of flexibility, we don't have under the RIA license. So under RIA license, we can just suggest our investors these trades, but these trades would be actually executed by investors. They have to be executed by investors. We can't really execute them, these trades for our investors. So that's the limitation of RIA structure. But in PMS, this limitation is not there. We are able to execute it well. But the other limitation is that of minimum ticket size, which is 50 lakhs in PMS. So one needs to invest bare minimum 50 lakhs in any PMS if they want to invest in a PMS. But yeah, the execution advantage is, I think, a very big advantage if somebody was to go ahead with a PMS structure.
Right, right. And Supriyo is also clarifying that he meant to say that he doesn't have 50 lakhs, hence needs something like 10 lakh bracket. So I think that's exactly, Supriyo, why SIFs were also launched by SEBI, one of the key reasons. So definitely, we are also checking internally. Okay, SK says, kindly share the rolling returns of the strategy. Could you also let us know, won't rolling returns displayed on your site or small case be a better metric to judge the portfolio performance? Definitely, definitely. Vivek, your take.
So I don't think rolling returns are there on small case platform, right?
They're
Yeah.
not there in they don't so small case is doesn't allow a lot of customizations, so they only let us share the active live returns. In fact, the back-tested returns also they do not permit to display. So they are sharing the active live returns based on their calculations of our portfolio. We are not sharing our returns with them. They are only calculating based on the stocks that we upload in their system. Regarding rolling returns, we definitely track them internally to see how our performance has been, how we are performing, and we also look at the cone of confidence and a lot of other metrics which are based on rolling returns, in fact, to keep a check on how well our fund manager is doing and if there is a need to take action or a red flag. So definitely we can share it, Vivek. Maybe we can do a
Yeah,
blog.
Isha, so anyways, what we do at the start of every year is we publish a blog, which is a more detailed blog about our performance of the last year and historical performance. So we'll definitely do share rolling returns and other more detailed performance analysis in those blogs, and we'll share those blogs with everyone. So yeah, you can just check out gulaq.com in about a week's time, and this blog will be published there, and all these performance related details will be in that blog.
Sure. I think Night King Kills, okay, that's the handle. This person says that sometime back, the minimum investment in Gear 6 was more than 9 lakhs and now it's back to 20,000. So that was, I think, a glitch. And Vivek, if you would like to talk about it.
Yeah, there's a particular methodology that small case uses to uh, determine this minimum investment size. We typically want to keep it around 25,000 to 30,000, in that range. But due to a demerger that happened in, I think, I
September
forget
or
the
October? Either September or October.
yeah, what was the company's name, Eesha?
Odigma. Odigma was
Odigma.
the new
So
company.
Odigma was actually demerged from a company, and the allocation to Odigma that was there in our portfolio because of this demerger ratio was about, I think, 0.05% or something like that, very small quantity. And the way small case algorithm determines this minimum investment sizes, it wants to give you at least one lot or one share of that specific stock. And even if you had to buy one lot of Odigma, the minimum ticket size by that methodology becomes about 9 to 10 lakhs.
Yeah.
So just to fix that, we have to uh, virtually rebalance that our portfolio, which was not meant really for existing investors. It was just meant to fix that specific problem that we faced. Yeah, but now I think it's fixed. It's back to that 25 to 30,000 range.
Right, right. And the percentage became so low, 0.5 or 0.05%,
0.05.
because this stock was, it was a demerger, and the actual stock that was in our portfolio was actually of a higher amount and the weightage was higher. But because it was demerged, the amount became too less and the weightage became too less proportionately as per the demerger rules. And this is why this entire situation happened with all the people who had Odigma shares in their kitty, in their basket. Okay, rolling returns, this one. Okay, so Supriyo says, please ask small case to at least start the rebalance plus SIP at the earliest. I think what he means is that small case doesn't let you do it in a combined way. Right now, you
Yeah,
first have to rebalance and then you do an SIP,
then you have
which means certain stocks that you sell, you end up buying again
to,
right
yeah.
at that moment. So that is something we're pushing them. Thanks a lot. Noted. We'll talk to them again about the same. Uh, SK says that, as in my case, my first investment was on Jan 15th, 2024. Gear 6 has given positive returns, but my portfolio is down around 7%. My last investment was on August 1st during the rebalance.
Yeah, I think what Isha mentioned some time back, it could be a factor of your brokerages that you are paying. I think that is one very big factor that I've seen in portfolios overall.
Right.
If you are with a full service broker and the broker is charging you those very high brokerage rates, then it is certainly possible, along with rebalancing on time and other slippages. What we have typically seen is these slippages over the year should take maybe about 2 to 3% from the reported returns. So if we have reported on small case returns are, let's say, 20%, then about 2 to 3% would be slippages. So what you should end up realizing is about maybe 17% returns. But if your rates are high, then again you might end up paying maybe even 3 to 4% overall. So that is the kind of slippages we are looking at, which includes slippages and brokerages. So brokerages definitely are in your control to an extent. Slippages are not. So slippages you will always end up paying about 2 to 3%. That's what the leakage would be. But brokerage is something that you should definitely look at.
Yeah, brokerage, and also like he mentioned that he uh, did his additional investment on August 1st. So he in fact says that, that's why rolling returns are needed, and a blog on the same would be great.
Actually,
Happy to share that. Yeah,
I
Vivek.
think better than rolling returns, XIRR is the thing that you should look at. So what you should do is you can download the data daily return series from small case platform, right? When you download it, use that data and the dates that you have actually invested money, right? So if you're investing 10,000 per month on the first of every month, it's fairly easy to calculate the XIRR. So there's a difference between XIRR and CAGR. And if you have been investing all throughout, let's say last 6 months, then your XIRR or the returns that you are realizing would be lower than the overall returns that are being displayed. So there's a difference between CAGR and XIRR. I think we have written something on those lines in our a few of the communications also, but that is one reason I see many investors tend to get confused between these two terms. But there is a fair bit of difference between XIRR and CAGR. XIRR is used when you don't have one investment, you have been investing across that time frame, right? CAGR is only used only in case when you have uh, invested once and then you have not invested over time. So that's the difference. For most of us who do SIPs or keep investing, XIRR is the right metric and not the CAGR.
Um, yes, that's true. So SK says, I think XIRR won't be as effective if the minimum period passed is not at least 1 year.
Yeah.
Yeah.
So it's not a very good metric, and that's why small case does not show you XIRR if your investments have been in there for less than a year. Yeah. But you can actually calculate it. It's not because let's say over last 1 month, if you have generated, let's say 2.5%, then annualized it becomes about 30%, right? So extrapolating that short-term performance over long run is not right. That's why XIRR is typically used when you have been investing for more than a year.
Right. Okay. The Curious Explorer says that he has a retirement corpus of 1.3 crores and Gulaq provides advisory services. So where to invest that fund?
So as of now, what we are providing is advisory in terms of advisory service, the stock-based portfolios and RPMS. But we do have plans to get into mutual fund advisory as well. So currently, we are not providing that kind of advice, but we do have plans to get into it eventually. We will be starting with rolling out our mutual fund advisory in the next few months, and after that, we'll get into financial planning and other sorts of advisory as well. But as of now, we don't really provide that kind of service. There's no way we can provide this kind of advisory at scale. So, but we are working on it. This is something that is in the plans, and we'll roll out this kind of advisory in the next few months' time.
Okay. Night King Kill says during rebalancing, we sell 1 to 2 shares of a stock and keep the remaining stocks as is. I think that's not necessary because of the DP charges.
Yeah, so DP charges is again something that we have considered in our back tests. So when we try to optimize for returns, we do take into account some bit of slippages. some bit of brokerages, and also these DP charges. So we have definitely taken into account, we do definitely do understand that for smaller accounts that could, these DP charges could be reasonably high as a percentage of your portfolio. And that's why we recommend that to have at least 2.5 to 3 lakhs in Gulaq portfolio. That's the recommended amount. Although you can start with about 30,000, but the recommended amount is about 2.5 to 3 lakhs. Then this will stop impacting you as much as if your portfolio is much smaller. But we do take DP charges also into account when we backtest these strategies.
All right. I think, Vivek, we are done with the questions in the chat box. Now we can move to
We can
and then we can come back if there are more.
Sure. So you can see my screen?
Yes, we can see your screen.
Yeah. So there is a question about returns. हम returns पाने में क्यों पिछड़ रहे हैं? Ajay Kumar has asked. For the past 12 months, I haven't seen any positive returns. My issue is false advertising. Gulaq Gear 6 shows 15% returns, but I have been invested for 1 year and my returns are almost zero since I pay subscription fees. Technically, I'm facing losses. Yeah. So regarding returns, I think we have already spoken about our performance. If you consider over long run, our performance is still very, very strong. If you consider last 1 year, it was pretty average, and a lot of investors are not really happy. And the thing I'll repeat once again that I think this is the by design, all the active funds go through this kind of phase. And I have very this example I keep quoting, that of Peter Lynch's Magellan Fund. So he was the fund manager of this very famous Magellan Fund for 13 years. And in those 13 years, he generated about 29% CAGR, whereas the S&P, the benchmark, produced about 13% only. Right. So there was a huge difference between what he was able to produce versus the BSC. So he did phenomenally well for those 13 years. After those 13 years, there was a study done of all the investors and how much they made. And the surprising fact about that study was more than 50% of the investors actually lost money. It's not the alpha. I'm talking about actual negative returns in that fund. And why that happened was because after a few years of very good performance, there was huge inflow of new investors, right? But then there'll be small dip for maybe a year or two where it'll underperform, and that's where investors will go out. So most of the investors, what they were doing was they were coming in at top. After a small underperformance, they were exiting, right? And that's why more than 50% of the investors in that fund, the fund that generated 29% CAGR, but the investors actually were losing money because they were trying to time. So, and this was one of the best funds ever in US. So my point being that when even the best funds would keep losing money or underperforming from time to time, that's with every single active fund. I haven't seen any fund that keeps outperforming year after year. There's no mutual fund, no hedge fund, nothing like that. I haven't really seen any such fund. So this is really with the active fund performance. If you are invested in active funds, you have got to go through those periods of underperformance. And that's what we have gone through last 1 year, where we didn't generate any alpha. Yeah. So that's about performance. Now let's take the next set of questions. So again, just to repeat, over any 12-month period, are the probability or the chances of Gulaq Gear 6 beating the benchmark is not 100%. It is about 85 to 90%. So there's still some chance that over any 12-month period, we end up underperforming the index. And that is what we have seen. It's kind of zero active return over last 12 months or so. With every rebalance, multiple stocks are adjusted, which affects our LTCG. Additionally, Gulaq Gear 6 hasn't been able to manage losses. Okay, Saurabh, so again, when we design our strategies, as I mentioned, we do take into account the costs, and these taxes are part of the cost. So if we rebalance less frequently, then obviously these STCG would be converted into long-term capital gains tax, but the alpha that we are able to generate would also be significantly less. So these strategies that we have designed are optimized, taking into account the long-term and short-term capital gains taxes as well, right? So that's what I have to say. The alpha that we have been able to generate is because we have been able to churn on a monthly basis, and that's why this alpha, what we have seen, the returns over last 4.5, 5 years has been about 50% CAGR. Obviously, we have got to pay those taxes, but we have been able to produce those returns also because we have been very fast in adjusting our portfolios. Okay. Why do investors buy a share, sell it, and then buy it again next month? I've noticed this pattern with Oil India. Yeah, so Aman, I think I've already answered this question. This is a part and parcel of investing in any quant fund. So this will happen with any quant fund, that the churn would be high. Yeah. I've been using Gulaq Gear 6 for the past 7 months and invested. So far, my realized returns are negative. I think Eesha, a lot of these investors, from what I have, whatever interaction I have had, I think brokerages is one very big part of these overall costs. So I would really encourage everyone on this call to look at their brokerages, how much they are paying. Is there a way to reduce it with that existing broker, or maybe move your account to a different broker which is offering much better brokerages? Why has Gulaq moved away from their market cap agnostic investment methodology and created uh, large, mid, and small caps? So, Sakti, we have not really moved away. We are still offering our gear based portfolios. But as I said earlier, there were a lot of experienced investors who wanted us to uh, deliver these kind of large, mid, and small cap portfolios because they wanted to take that active call. So it is meant for those experienced investors. If you believe you can or you want to take that active call, then only go for this. Otherwise, we our focus is definitely on those gear-based portfolios. So we are sticking with our original strategy, but also offering something extra for our experienced investors. Yeah. Could you please try to reduce churn? It would positively impact our returns. So, Naresh, the changes that we have done in last 2, 3 months, this is exactly what I have mentioned earlier also, that our churn earlier was about 80 to 90%. Now the expected churn would be closer to 50%. So we have significantly reduced our overall churn uh, by the way of these newer portfolios, the changes that we have made in Gear 6, gear-based portfolios. You would see now that our overall churn has reduced drastically. Should rebalancing be done? My returns are on a need basis. So, Anil, this is something that we have tried out earlier a lot many times. That if we do need-based rebalancing, would the results be better than actually what we are currently doing, rebalancing at the end of every month? And the results are pretty clear that the current strategy of rebalancing on a fixed frequency, which is monthly, is actually a better strategy over long run. This is very clear in our mind that need-based rebalancing, in few of the instances, it might work, but that is not a good strategy to follow over long run. The current strategy that we are following is a better strategy than a need-based rebalancing strategy. Okay, Arijit is asking, I want to build a corpus of 50 lakhs within 3 years and then move to ST long alpha. Is Gear 6 suitable? Yeah, see, Gear 6 is a pretty solid, pretty good portfolio or fund. But what I would urge you is to look at your asset allocation and do not invest more than 20 to 25% in any one fund, right? And be it Gear 6 only, or be it any fund that you are really bullish on, do not invest more than 20-25% of your overall portfolio in one fund. That is the broad yardstick that you should use to invest, how much to invest in those funds. So, so based on that, you can decide if you have not reached that 20-25%, and if you really like our performance overall, then definitely you can invest up to 20 to 25%. Otherwise, yeah, that's what you need to follow. Right? I'm a big fan of your work. Thank you. I've been Gulaq Gear 6 subscriber since 24 and have happily extended my subscription with plans to continue. I have a concern. When the market performs well, our portfolio does well, but when our market declines, our portfolio. So I think this is what we have already addressed some time back, that this might have happened in the past couple of months, but this is not a pattern that we have seen in last 4 or 5 years of live track record, or even 12 years of data. So this is something that has happened in the recent past only, but we can definitely, as per the historical performance, we have outperformed in the bad years also, and we have underperformed in good years also. So the thing that you currently mentioned, this is not really a longer term pattern. This has just happened for the recent time being. Otherwise, this is not really a pattern. Okay, I've invested in Gulaq Gear 6 based on CAGR, but if my invested amount continues to go down, how can we address this gap? Now, again, see, this depends on two things. One, the overall market performance, and then how we are doing relative to market, right? But as I said earlier, with any of these active funds, you need to stay invested for longer periods. 1 year, you could definitely see underperformance in Gulaq Gear 6 or other active funds or mutual funds as well, right? So you've got to go through those periods of underperformance in order to realize those good returns that we have been giving over the last few years. Yeah. Yeah. So, Eesha, we have covered everything that we received earlier. Any more questions that we got?
Yeah, Vivek, we did get a few more questions. Let us just cover those quickly. So, Curious Explorer says, is there any tentative date for the advisory services that you were mentioning, we're discussing, and will be launching?
Any date? I don't have a specific date, but maybe in about 3 months' time, we'll launch something on mutual funds. Broadly, that's the timeline. It could be plus or minus 1 or 2 months, but that's what I think currently in my mind. About 3 months' time, we should be able to launch these mutual fund advisory services.
Right. Great. So Sachin says rebalancing at morning 9:30 a.m. is a good time or not? Please advise the correct time to rebalance, basically.
So what we have seen, market, it depends. Your slippages depend on market liquidity, how liquid the market is. And during the middle hours, the liquidity is the lowest. During the start of 1 hour and ending 1 hour, the liquidity is the best. So that's what I do typically. Either I rebalance on the starting 1 hour or ending 1 hour, but try to avoid rebalancing if your portfolio size is large. See, if your portfolio size is about less than 5 lakhs, I would say any time of the day is fine. But if it is larger than 5 lakhs, then maybe do it in the starting 1 hour or ending 1 hour.
So Vivek, just to clarify, you said the liquidity is low or high at the beginning?
Highest during initial 1 hour and last 1 hour. Yeah. Middle of the day it decreases. So avoid if your portfolio size is large. If it is, let's say, 2 lakhs, 3 lakhs, then I really don't think it will matter a lot. But if it is large, then yes, then during the start or end of the day.
I thought at the very beginning, at least in the initial 15 to 20 minutes, there is a lot of noise in the market.
So
Correct?
not 15 to 20 minutes, but maybe 5 to 7 minutes, I would say. First few minutes only there is noise. So avoid maybe 9:20 or 9:25. Before that, you should avoid. But after within 10 minutes, I think liquidity is pretty good. So
Okay.
after that, you can do.
Got it.
Just at the market open, yeah, there's noise and liquidity is also not very good. So just if you avoid those first 5-10 minutes, then it's okay.
Got it. Okay. Anupam says, is it the best time to invest more? Mhm.
So
Like,
Anupam, it depends. If you are investing for next 3 years, 5 years, or longer, then obviously you don't need to worry. And the best way to invest is through SIPs. If you keep investing every month, then this market volatility won't really impact you. But if you are investing for, let's say, less than 1 year, then don't invest in equities. That's what I have to say. And in fact, there's a very interesting, I found it very interesting, that blog that we wrote about the luckiest investor. So there was this study that we did that if you invest every month at the best time of the month, which is the lowest uh, of every month, versus if you are really unlucky and if you invest at the top of every month, the difference, if you keep doing this for say about 20-25 years, the difference between these two portfolios is not really too much. It was, I think, less than 5% difference, right? Versus if you keep investing blindly on the first of every month, then the results will be somewhere in between. So the point was, uh, this trying to time the market, whether I'm trying to invest at high or low, that is much smaller factor in your overall portfolio. What matters much more is whether you are by with discipline have been investing for long term or not. Then these decisions, whether market is at low or high, really won't make much of an impact.
okay. Someone says, sir, kindly change your strategy of rebalance on need basis. Monthly is not good for long term. If time not given to a stock to perform, it's not long-term investment.
So this is again, we are always driven by what data tells us, right? Uh, and there might be few instances that you would have observed in the last few months where we exited too early and after that stock kept on performing, right? So these kind of instances definitely we all do remember. But what we have got to uh, do is take decisions on the basis of data, what data tells us. And that's what we have seen, that if we do perform on need basis, that's not a very good strategy. We really won't be able to produce the kind of returns that we have produced over last 5 years. Uh, so, so yeah, that's what the data tells us very clearly, that the monthly rebalancing is a better strategy, and we're going to stick to it until and unless we are able to figure out a way to do need-based rebalancing and still outperform this strategy. But I think this strategy is performing fairly well. If you see last 4.5-5 years performance, about 50% CAGR we have delivered. So overall, we are quite confident that we'll do pretty well over next five years also. I'm really doubtful if we'll do, or any fund will be able to do about 50%. But yeah, I think we should be able to do pretty well. Whether we are able to repeat or not, that's I think, don't think that that's the right question also, because we launched at the lows of COVID. From that, obviously, market has given phenomenal returns. So I don't think anyone should expect the kind of returns that Gulaq or even equity markets in general, what they have given in last 5 years. I don't think that kind of returns would be possible in next 5 years.
Yeah, because markets we saw gave around 29-30% and Gulaq gave about 50% CAGR. But, you know, we did outperform substantially. But like Vivek said, the markets as well as Gulaq, you cannot expect that much. And two things I would like to add in response to the question. One is on the need-based part of the question. Of course, if we look at need-based, who will determine that it's need to kind of rebalance right now? That means that there is a manual intervention. There is a person thinking that, oh, markets are going up or markets are going down. Let me rebalance. So at the beginning of the webinar, we discussed why we are quant-based or algo-based and why we focus on the algos and the computer models and the data that's coming. So for a systematic way of investing, we need to put one date when we will review the model and when we will rebalance it. That's why need-based is not possible. And secondly, you mentioned that long-term, we're not doing long-term if we are churning our stocks so often. Well, that's not true. A lot of these in long-term, large cap active funds that are out there, or all the other mutual funds, active funds that are out there, for you, you will see the NAV, but you would not know how frequently at the back end the manager is actually churning the portfolio. They could even do it daily for a few days if they feel the need. Over there, if it's a manual fund, if it's quant based, again they could have their model. Some could be doing it weekly, some could be doing it monthly, some even quarterly. So mutual funds are also advised. We advise people to stick to the long term, and if they want to, they should invest in mutual funds. But long term does not necessarily mean that from an investor point of view, yes, you stay invested for the long term. But from a manager point of view, if you are looking at a fund or a portfolio, you could keep churning it. But if you're talking about individual stocks that, hey, I want to invest for the long term, I've bought the shares of Tata, I've bought the shares of, let's say, Taj HCL, then yes, it could be a longer time frame till when you hold it. So Vivek, I hope it makes sense what I'm saying.
Yeah, definitely. Yeah.
Okay, all right. Okay, now the next one is AI Amin. What brokerage do you currently suggest? I'm investing through Grow. Is it good to continue?
Yeah, I don't know the exact brokerages, but Grow, Zerodha, these are part of the discount brokerage firms which offer uh, some of the best rates. So I think if you are with Grow, you are definitely, uh, at least in terms of brokerage, I think it would be very, very competitive.
Right, right, right.
Yeah.
Okay, I see one last question. Supriyo says moving investments to another broker is so much, it's troublesome. Tried to
Yeah.
move from Kite to Dhan either on my older subscription, but the associated cost is too much. I I think that's true. So Kite, I'm not sure why you want to move out, because Kite is a pretty good broker. A lot of us are using it already, and it's a discount broker. So the
Yeah.
brokerage rates are also not applicable. It's just the DP charges and other things. But yes, that's true. If you want to switch one, you should switch only at the end of your subscription, because that's again a thing with small case. It's a operational side issue with small case, that you are unable to move from the one subscription to the other. Like, you'll have to take another subscription of Gulaq with the new broker. I'm not sure if that has been changed recently, but last when we checked, when some of our investors wanted to make the switch, they were unable to on the existing Gulaq subscription. So we would recommend to at least continue on the existing subscription. And if you're facing issues, small case team should be able to respond to you promptly for any of these operational issues. So please reach out to their support email ID, and you can even reach out to support@gulaq.com. We can help you and we can assist our clients in reaching small case and help you with these kind of activities, whether it's a technical bug or an operational issue. We'll be happy to help. Yeah, I think that's about it. I don't see any other questions. But yeah, I would like to take a minute, to thank everyone. It's been a pleasure hosting these webinars, but just to let everyone know, I won't be hosting it from the next month onwards, because I'll starting something of my own. So it's always been nice, Vivek, to host these webinars with you as well. I always used to look forward to interacting with you, to interacting with our audience, taking all the questions, and it's been a fun ride, and thanks a lot, everyone.
Thank you, Eesha. Thank you, everyone. We'll definitely miss you, Eesha, here.
Yeah, no, but you can always follow me at Finance with Eesha. Started a new Instagram page, and I'll be doing more things there. So hoping to continue and hoping to see what we can also do together in the future. So that's always there. But great being here and interacting with everybody and with you, Vivek. Thank you so much.
Thank you, Eesha. Thank you, everyone.
Thanks, everyone. Bye-bye.